Ever wonder what the big players really buy when markets are uncertain? It's not what you think. Let's expose the hidden system they use. Pause, what's it all for? Ever wonder what the big players really buy when markets are uncertain? It's not what you think. Let's expose the hidden system they use. Pause, what's it all for? Okay, let's dive in. We're talking about smart money. These aren't your average retail investors checking TikTok and chasing the latest meme stock. Smart money encompasses hedge funds, institutional investors, family offices, the folks managing billions, sometimes hundreds of billions, of dollars. And they don't panic sell when things get rocky. They buy. But they buy strategically. They're not looking for the next quick buck. They're building positions, anticipating future growth. The first thing most people assume smart money does in an uncertain environment is load up on gold, right? Safe haven assets. Classic move. And yes, they do allocate to those. But what if I told you a significant portion is quietly moving into something completely different? Something that flies in the face of conventional wisdom. Let's look at Citadel. Ken Griffin's hedge fund, managing over $88 billion, recently increased its position in Palantir by a staggering 240% in the last quarter alone. Palantir. The data analytics company known for working with government agencies and businesses. Its stock has been volatile, hammered by market fears and concerns about profitability. Why would a fund as sophisticated as Citadel pour that much capital into a company many consider risky? It's not just Citadel. Ray Dalio's Bridgewater Associates, the world's largest hedge fund with over $150 billion in assets under management, has been quietly increasing its holdings in energy infrastructure companies, specifically, Kinder Morgan. Kinder Morgan, the largest energy infrastructure company in North America, transports natural gas and petroleum products. They're not betting against the energy transition. They're betting on the continued need for traditional energy during the transition. They're recognizing that renewable energy adoption takes time, and existing infrastructure will be crucial for decades. This isn't about sentimentality. This is about understanding the underlying dynamics. They're looking at the data, assessing the risk-reward ratio, and identifying opportunities that most retail investors are overlooking. It's about anticipating a trend rather than reacting to it. But that's not the strangest part. You see, the smart money isn't just buying individual companies. They're buying entire sectors through a somewhat opaque system known as contractual obligations. These aren't easily visible on public filings. They're often embedded within complex derivative structures and private agreements. Consider Millennium Management, another powerhouse hedge fund with over $48 billion in assets. Their filings reveal a significant increase in investments tied to agriculture, specifically, land and water rights. We're not talking about investing in agricultural companies. We're talking about acquiring the fundamental resources necessary for food production. They've been quietly accumulating contracts related to irrigation rights in California, fertile farmland in the Midwest, and even timber rights in the Pacific Northwest. Why agriculture? Well, food security is becoming an increasingly pressing global concern. Climate change, geopolitical instability, and supply chain disruptions are all contributing to rising food prices and potential shortages. Smart money isn't just looking for profits, they're hedging against future risks. They're essentially building a portfolio that's insulated from economic downturns and societal instability. And it's not just food. They're also strategically positioning themselves in cybersecurity. Point72 Asset Management, run by Steve Cohen, has dramatically increased its investments in companies specializing in ransomware protection and data encryption. The attacks are becoming more frequent and sophisticated, and businesses are desperate for solutions. It's a defensive play, anticipating a continued rise in cyber threats. These aren't impulsive decisions. These are the result of extensive due diligence, complex modeling, and a deep understanding of global trends. They have entire teams of analysts dedicated to identifying these opportunities. They're employing sophisticated algorithms and AI to predict market movements and uncover hidden assets. But that's not the strangest part. Here's where it gets really interesting. While they're publicly disclosing some of these investments, much of what they're doing is hidden within private equity structures and offshore accounts. These aren't illegal, per se. But they're designed to obscure their intentions. Think of it as a layer of financial camouflage. A recent report by the Financial Stability Board highlighted a concerning trend, a significant increase in shadow banking, financial activities that operate outside the traditional regulatory framework. These structures often involve complex partnerships and opaque ownership, making it difficult to track the flow of capital. While it's impossible to know the full extent of their activity, estimates suggest that smart money is quietly deploying upwards of $47 billion into these alternative investment vehicles. $47 billion. That's money that isn't showing up on standard stock market indexes. It's money that's influencing markets behind the scenes. It's creating a two-tiered system, one for the retail investor who sees the headlines and reacts emotionally, and another for the institutional investor who operates with a long-term vision and access to information. The reason they're doing this is multifaceted. It's about minimizing taxes, avoiding regulatory scrutiny, and maximizing returns. But it's also about maintaining a competitive advantage. If everyone knew exactly what they were doing, the opportunity would disappear. And the biggest piece of the puzzle, the twist nobody expects? They are all, quietly, investing in water purification technology. Specifically, funds like D.E. Shaw & Company, managing over $58 billion, have been steadily increasing their exposure to companies developing advanced filtration and desalination systems. This isn't just about providing clean drinking water in developing countries. It's about securing access to a resource that will become increasingly scarce due to climate change, pollution, and population growth. Water is the new oil, and smart money knows it. Think about the implications. We're talking about a fundamental shift in how resources are allocated. The biggest players are recognizing that the traditional narratives about risk and reward are changing. They're not just looking for the next hot stock. They're investing in the underlying infrastructure and resources that will sustain society in the decades to come. So, what does this all mean for the average investor? It means we need to be more discerning about our investment decisions. We need to look beyond the headlines and understand the underlying trends. We need to think long-term and be willing to challenge conventional wisdom. It's not about trying to copy what smart money is doing exactly, that's nearly impossible. But it's about understanding their thought process. It's about recognizing that investing is not just about chasing returns, it's about anticipating the future. It's about building a portfolio that is resilient, diversified, and aligned with your long-term goals. The world of investing isn't a level playing